Hey everyone, welcome back to the channel. Today, we're tackling a topic that can feel super intimidating but is absolutely life-changing, especially if you're in your 20s. We're talking about investing. I know. The word itself can sound complicated, like it's only for people in suits who stare at blinking numbers all day. But I promise you, that's not the case. The truth is, the easiest and most powerful time to start investing is right now, in your 20s. And the best part? It's way easier than you think. So, why is investing in your 20s such a big deal? It comes down to one magical concept: compound interest. Albert Einstein supposedly called it the eighth wonder of the world. And for good reason. Think of it like a snowball rolling down a hill. It starts small, but as it rolls, it picks up more snow, getting bigger and bigger, faster and faster. Your money works the same way. When you invest, your money earns returns. Then those returns start earning their own returns. It's a cycle where your money starts working for you, building wealth on its own. Let's break it down with a simple example. Imagine you invest $100 a month starting at age 25. Let us say you get an average annual return of 8%. Okay, so you're convinced. I need to start, you're saying, but where? How? This is where most people get stuck, and it's totally understandable. The world of investing seems like a maze of stocks, bonds, and acronyms. But here's the secret. You don't need to be a stock-picking genius. The easiest way to start is with something called a low-cost index fund, or an ETF. Let's demystify that. An index fund is like a basket that holds tiny pieces of many different companies. For example, an S&P 500 index fund holds small shares of the 500 largest companies in the U.S. Think Apple, Amazon, Microsoft, and so on. Instead of trying to guess which single company will be the next big thing, you're betting on the overall growth of the entire market. History has shown that, over the long term, the market tends to go up. By owning a piece of everything, you diversify your risk and ride the wave of general economic growth. You're not putting all your eggs in one basket. You're buying a tiny piece of the entire farm. ETFs, or exchange-traded funds, are very similar. They also hold a collection of stocks or other assets, and they trade on the stock exchange just like an individual stock, making them super easy to buy and sell. Many ETFs are index funds. The key phrase to look for is low cost. You want funds with a low expense ratio, which is the tiny fee you pay for the fund to be managed. We're talking fractions of a percent, often less than 0.1%. These small fees make a huge difference in your returns over time. So, how do you actually buy these magical index funds or ETFs? You need a brokerage account. Don't worry, this isn't as formal as it sounds. A brokerage account is simply an account that allows you to buy and sell investments. Opening one today is as easy as signing up for a social media account. There are many fantastic, user-friendly apps and websites out there, like Fidelity, Vanguard, or Charles Schwab. Many of them have no minimum deposit, so you can literally start with just $5 or $10. You just download the app, link your bank account, and you're ready to go. Once your account is open, you can search for a specific index fund. A great place to start for many is a total stock market index fund or an S&P 500 index fund. Some popular tickers are VTI, which tracks the total U.S. stock market, or VOO, which tracks the S&P 500. You simply type in the ticker symbol, decide how much money you want to invest, and click Buy. That's it. You are officially an investor. You own a small piece of the biggest and most successful companies in the world. Now, for the most crucial part of this strategy, consistency. The goal isn't to get rich overnight. The goal is to build wealth steadily over time. The best way to do this is through what's called dollar cost averaging. This just means investing a fixed amount of money at regular intervals, say $50 or $100 every month, regardless of what the market is doing. This approach is brilliant for a few reasons. First, it makes investing a habit, just like paying a bill. You can set up automatic transfers from your bank to your brokerage account, so you don't even have to think about it. Pay yourself first is the mantra. Before you spend money on anything else, a portion goes straight to your investments. Second, dollar cost averaging takes the emotion out of investing. The stock market goes up and down. That's normal. When you invest a fixed amount regularly, you automatically buy more shares when prices are low and fewer shares when prices are high. It smooths out your purchase price over time and prevents you from making panicked decisions, like selling everything when the market dips. Remember, we are in this for the long haul. Those dips are just temporary sales for long-term investors. Let's talk about a common fear. What if I lose all my money? It's a valid concern. Investing always involves some level of risk. However, by investing in a broad market index fund, you are spreading your risk across hundreds or even thousands of companies. For you to lose everything, the entire US economy would have to collapse to zero, and in that scenario, we'd probably have bigger problems to worry about. Historically, while the market has had bad years, it has always recovered and reached new highs over the long term. Time is your safety net. Another option that makes things even simpler is a target date fund. These funds are designed to be a complete all-in-one portfolio. You pick a fund with a year in its name that's closest to when you plan to retire, for example, a target date 2 through 65 fund. This fund automatically invests in a mix of stocks and bonds and gradually becomes more conservative, meaning less risky, as you get closer to that date. It's the ultimate set-it-and-forget-it option. You just contribute money to it, and it does all the work of balancing and adjusting for you over the decades. So let's recap the simple 3-step plan to start investing in your 20s. Step 1. Open a brokerage account with a low-cost, reputable company. It takes minutes. Step 2. Choose a low-cost, broad market index fund, ETF, or a target date fund. Don't overthink it. A simple S&P 500 or total market fund is a fantastic starting point. Step 3. Set up automatic, recurring investments. Start with whatever you can afford, whether it's $25, $50, or $100 a month. The amount is less important than the habit. You can always increase it as your income grows. The biggest mistake you can make is waiting. Don't wait until you know more or have more money. The learning happens by doing, and the best time to plant a tree was 20 years ago. The second best time is today. By taking these simple steps, you are giving your future self the incredible gift of financial freedom. You are starting your money snowball at the very top of a long, long hill. Thank you so much for watching. I hope this broke it down and made investing feel way more approachable. Your future is too important to leave to chance. If you found this helpful, please hit that like button and subscribe for more content on making your money work for you. Let me know in the comments if you've started investing or what questions you still have. See you in the next video.